Today, for the Series 6 exam, we are covering a crucial topic that you are almost guaranteed to see: the taxation of variable annuities. Let's start with the core benefit that attracts investors to these products, which is tax-deferred growth. When an individual invests in a variable annuity, the money placed in the separate account grows without any taxes being due on the dividends, interest, or capital gains as they are earned. This allows the investment to compound more rapidly compared to a taxable brokerage account where gains and income could be taxed annually. This tax-sheltered accumulation is a powerful feature, but the exam will focus on what happens when the money is withdrawn. When an annuitant decides to take money out of a non-qualified variable annuity, the taxation follows a specific rule: last in, first out, or LIFO. This means that all the earnings, which is the last in money, must come out before any of the original investment, the first in money, can be withdrawn. The original investment amount is known as the cost basis, and it is returned tax-free since it was made with after-tax dollars. However, the earnings portion is fully taxable at the annuitant's ordinary income tax rate, not the more favorable capital gains rate. Let's walk through a typical exam scenario. Suppose a client, age 50, invested $100,000 into a variable annuity. 10 years later, the account has grown to $160,000. The client has a $100,000 cost basis and $60,000 in earnings. Now, the client decides to withdraw $50,000 for a home renovation. According to the LIFO rule, this entire $50,000 withdrawal is considered to be from the earnings. Therefore, the full $50,000 is subject to ordinary income tax. The client's remaining account value would be $110,000, which consists of the original $100,000 cost basis and $10,000 of remaining earnings. But the tax consequences don't stop there, and the exam loves to test the extra penalty. Because the client in our example is only 50 years old, the withdrawal is happening before the critical age of 59 and a half. The IRS imposes a 10% penalty on the taxable portion of any early withdrawal. In our example, the client would owe a penalty of $5,000, which is 10% of the $50,000 taxable withdrawal, in addition to the ordinary income taxes. Exam questions will frequently require you to identify the taxable amount and calculate this penalty. A common trick is to present a scenario where the withdrawal amount is less than the total earnings. Remember, under LIFO, as long as there are earnings in the contract, any withdrawal is considered earnings first. A frequent trap for test takers is confusing this with the FIFO, or first in, first out, treatment of life insurance cash value withdrawals, or the pro rata taxation of mutual fund distributions. You must associate variable annuities with LIFO. Another point of confusion is the tax rate. The growth is always taxed as ordinary income, regardless of how it was generated within the separate account. Even if it was all from long-term stock appreciation, it does not qualify for capital gains rates upon withdrawal. To keep this straight during the exam, use this simple phrase: with annuities, the tax man gets the last laugh first. This helps you remember that the last money in, the earnings, is the first money out and the first to be taxed. And for the penalty, think 59 and a half is the key to the door. Any younger and you pay more. This mental shortcut can help you quickly identify the age-related penalty and apply it correctly to the taxable earnings portion of a withdrawal.